Welcome to the Pro Ticker Deep Dive.
Today we are diving into, well, what might be the most paradoxical story in the consumer sector right now.
Absolutely. It's all about quick service versus fast casual dining, and everything we thought we knew, all the conventional wisdom, has just been completely inverted.
It really has. I mean, if you look at the trends for 2025, you just assume the healthier, more modern concepts, the fast casual ones would be the market darlings.
Especially with the premium they charge. But our mission today is to unpack a crisis that isn't hitting everyone the same way. It's what we're calling a bifurcated meltdown.
And the central fact here is just astonishing. You have Chipotle, the poster child for fast casual disruption, basically in crisis mode.
The stock is down almost 50%, right, year to date.
Yeah, nearly 50%. And then you contrast that with the legacy players, the QSRs.
The McDonald's of the world.
Exactly. McDonald's, Restaurant Brands, International, Burger King's parent, they're all showing these steady, measured gains.
It's the ultimate inversion story. I mean, the disruptive challenger is being out-executed by the entrenched incumbent. You just have to ask why.
Right.
Why is the company that's all about fresh, customizable food just falling apart while the old-school burger joints are quietly, executing their way to profitability?
And that's what we're going to get into. We're going to drill down into the three structural reasons why these different business models are really determining the winners and losers here.
In this, this very strange environment of a consumer spending collapse and this tariff nightmare that just won't go away.
To really understand that bifurcation, we have to start at the epicenter of it all, which is the Chipotle crisis.
Okay.
The numbers that came out of their Q3 2025 report were, frankly, shocking. They signaled a fundamental operational crisis that goes way beyond just, macro headwinds.
Well, let's unpack those hard numbers, because this is where the trouble really starts to show. Same-store sales growth, which is, the core metric for any restaurant's health, it crawled to just 0.3% growth in Q3.
0.3. And that's not just slow. It's a catastrophic drop when you remember they were reporting 6% growth just the year before.
And here's the really critical insight for you to focus on.
Yeah, this is the kicker.
That tiny little bit of growth was entirely because they raised prices. It was all menu price increases.
So the actual number of customers, the transaction volume actually declined by 0.8%.
A drop in traffic. That means you are actively hemorrhaging customers. And if your only path to growth is charging the people who are still there more for the same thing.
That model is completely unsustainable. You're just abusing your loyal base until they have no choice but to leave.
And it seems like management finally gets that. They've capitulated to this reality.
Oh, they did. We saw this stunning reversal of expectations. They revised their guidance, and now they're forecasting low single-digit comparable sales declines for the full year.
And that's what sent the stock tumbling.
A 13% drop after hours. They basically just signaled to the entire market that their growth story is broken, at least for the immediate future.
So who exactly is leaving? Who is this customer they're losing?
It's their core market, the middle-income diner. This group is about, 40% of their customer revenue?
Roughly 40%, yeah. And they are pulling back sharply. This is the group that's getting squeezed the hardest by everything. Inflation, weak wage growth.
And the big one, the resumption of student loan repayments.
That's a huge one. It just eliminated disposable income for millions of households overnight.
And Chipotle's price point, a burrito bowl can be $12, maybe $15 a person. That puts it just out of reach for this group now.
It's a treat. It's not a Tuesday night dinner anymore.
Exactly. It forces them to look elsewhere. And that elsewhere is precisely where the traditional QSRs are winning, positioning themselves as, the necessary economic lifeline.
Okay, so let's pivot then. Let's talk about the disciplined approach we're seeing from McDonald's, because the contrast here is just so stark.
It really is. While Chipotle is struggling to even hold on to that tiny bit of growth, McDonald's delivered 3.6% global comparable sales growth in Q3.
And their consolidated revenue was up a steady 3% year over year. It's just methodical execution.
What's so fascinating to me is how McDonald's has weaponized its scale, and specifically its loyalty program. They've turned customer data into a financial moat.
An astonishing financial moat. We were talking about their loyalty program generating $34 billion in system-wide sales.
Over the trailing 12 months, it's an incredible number. $9 billion of that came in Q3 alone.
So this is not just some marketing gimmick. This is a built-in machine for driving repeat visits and protecting their volume.
Absolutely. Their customer relationship is now a fundamental financial asset. And they completely nailed the value narrative during this whole downturn.
with the $5 meal deal.
That deal wasn't just a promotion, it was a brilliant strategic move.
It really was. It was a psychological win, and I think that's the key. When consumers see that $5 price point again, it almost doesn't matter what's in the box.
Right.
They feel grounded in a known economic reality. It reset price expectations for the whole market, and that shielded McDonald's while everyone else was struggling to justify higher prices.
And this execution is broader than just the Golden Arches. You look at Restaurant Brands International, RBI.
The parent of Burger King?
Yeah, and they're showing real structural strength. That whole reclaim the flame turnaround strategy for Burger King is working. It's accelerating.
What were their numbers?
They posted 3.2% U.S. comparable sales growth in Q3. That was their best performance in nearly a year.
And RBI has that necessary diversification.
They do. Their international operations surged 6.4%. And then you have Tim Hortons, which is just the steady anchor in Canada, adding another 4.2% in comps.
So their overall system-wide sales grew almost 7%.
6.9%. They aren't just relying on one concept in one squeezed market. They have excellence across different geographies and different price points.
Which brings us to the core of this whole thing, the structural divide. There are three main factors explaining why these business models are just diverging so sharply right now.
Even though they're facing the same rough economic tides.
Right. Factor one is that deepening consumer bifurcation we mentioned earlier.
Yeah.
The economy is just split sharply in two.
Yeah, you have the affluent diners who are continuing to visit fast casual, fine dining. You know, the top end of the market is fine.
But everyone else, the lower to middle income bracket, they're making some extreme choices.
They're either trading down drastically to QSR value meals or, and this is happening more and more, they're just skipping meals out and eating exclusively at home.
And the traffic data confirms this, right? It
Yeah.
shows this dramatic shift.
It does. QSR locations saw a noticeable 3.4% decline in total visits in August. So people are making fewer trips overall, but fast casual.
They barely grew.
Only 0.5% growth. So that shows you they are not capturing the customers who are trading down. Those customers are skipping that mid-tier entirely.
They're fleeing to the cheaper, known alternatives or just going to the grocery store.
Exactly. Which brings us to factor 2, cost structure vulnerability. And this is where that fresh ingredient, high-quality model becomes a massive liability, not an asset.
Especially in a high inflation environment. We know over 90% of operators reported food cost increases in 2025.
And a huge chunk of them, about 36%, saw hikes of between 6 and 14%. That's massive.
Right, and then you layer the tariffs on top of that.
Nearly 80% of operators expect those tariffs to slash their profit margins by a third or even more.
It's an issue of rigidity, isn't it? I mean, McDonald's has scale. Its franchising model, its ability to buy core things like potatoes and beef in these enormous locked-in contracts.
It gives them pricing buffers that a company like Chipotle simply doesn't have.
McDonald's is like a massive oil tanker. It moves slowly, but it can absorb these huge economic waves like inflation and tariffs.
While Chipotle is a speedboat, it's fast in good weather, but it's capsizing in these rough seas.
It's a great analogy.
I mean, Chipotle's model, with its high margins and fresh ingredients, makes it nearly impossible to absorb these rising costs without driving away even more customers through more price hikes. It's a vicious cycle.
And factor 3. This one is about digital engagement versus just digital efficiency.
Yeah, this is a subtle but really important point.
Chipotle's digital efficiency is structurally impressive. I mean, 37% of their revenue comes through digital channels. And the Chipotle is in 80% of their new stores.
That's fantastic operational efficiency. But the problem is it isn't converting into long-term customer retention right now.
Whereas McDonald's weaponized its loyalty program for engagement.
Exactly. They aren't just taking digital orders. They are leveraging the data from those $34 billion in loyalty sales to drive repeat visits, to personalized promotions.
They moved beyond just being efficient to being truly strategic. They're
Yeah.
building habits that are hard to break.
Right. And when we connect all this back to the bigger picture, the unit economics gap is probably the single most sobering data point for you, the investor, to understand.
We have to look at the margin difference.
This is a critical distinction. Chipotle's restaurant-level operating margin slipped to 24.5% in Q3. That's down from 25.5.
And that's the profitability of an individual location before you even factor in corporate costs.
Right, and it's under immense pressure from food and labor costs. Now, compare that to McDonald's,
Which operates a mostly franchised and real estate-heavy system.
which means it reports a 33% net profit margin.
Nearly double what Chipotle is achieving at the restaurant level. That is just staggering.
And that's why the business models are so different. McDonald's makes money not just from selling burgers, but from rent and franchise fees. It's a stable, high-margin income stream that is structurally immune to a lot of these food cost spikes hitting Chipotle.
And that structural advantage in profitability is, it's essentially insurmountable in the short term.
It really is. But let's look forward a bit. Let's start with Chipotle's bull case.
Okay, the optimistic view.
The optimists will still point to their long-term capacity to reach 7,000 units, so expanding their footprint significantly.
And they're making these big bets on automation to solve that high labor cost structure we talked about.
Right. You have systems like the Hyphen Digital Make Line for automated bowls and the Avocado processing robots for, consistent guacamole prep.
That automation story is critical for them. If those technologies can deploy at scale in 2026, they can materially reduce labor costs and improve consistency, which is a big customer complaint.
It is. Plus, they announced that $1 billion buyback, which is a classic move to signal confidence and support the stock.
But the bear case seems much more grounded in reality right now.
It certainly does. The momentum is plainly negative. They're guiding to comp declines. Their pricing is driving away their core customers.
And the stock's valuation is still really high. A PE ratio of 27.4 still prices in a return to, 10% plus growth.
Which just seems like a fantasy in this consumer environment.
And so for McDonald's, the outlook is
Stability and expansion. They're planning aggressive expansion, targeting 2,200 new restaurants annually. And it's all fueled by these successful value and loyalty strategies.
their stock trades at a steady 25.9 PE, which feels like a fair price for that kind of consistent recession-resistant growth.
And RBI, it offers a defensive, maybe undervalued play. The Burger King turnaround is genuinely working.
And it trades at the lowest PE of all three, right?
Yeah, 24.05. Plus, you get a very attractive defensive 3.76% dividend yield.
The stock charts tell this entire story almost instantly if you just look at the price action.
They really do. Chipotle, CMG, has just had a gut-wrenching 49% decline this year. It's in a clear downtrend, and the technical picture looks highly bearish until it can somehow hold above the $40 level.
And that $40 level is likely a key moving average or some previous support that's now just heavy resistance.
Exactly. Meanwhile, you look at McDonald's, MCD, and RBI, which is QSR. They are the models of steady execution.
Both are trading near the top of their 2025 ranges. It just confirms that their methodical, value-driven strategy is winning investor confidence and delivering returns.
So if we synthesize all of this whole fast food crisis is fundamentally a test of structural survival.
Survival against a relentless consumer spending squeeze, while also trying to absorb these significant, unavoidable tariff costs.
And the scorecard is pretty clear.
Scale and value positioning are decisively beating disruption and premium pricing. Chipotle is, for now, a broken growth story because its core customer base has just evaporated.
Which leaves this real provocative question for them. It's not just about price anymore. It's about whether they can fundamentally redefine their position to attract an entirely new customer segment.
Or, if that impressive automation tech we talked about, the Hyphen and the Avocado, can it truly save a business whose core value proposition has been functionally destroyed for the market they once proudly owned?
Can technology rescue a crumbling customer base?
That's something fascinating for you to mull over.
You'll leave that hanging.
See you all in the next Pro Ticker Deep Dive.